Welcome to Compound Insights, CFA Society New York's podcast. I'm Rob Rowan. Today on the podcast, the current quality of ESG data, who the most important clients of ESG indices are now, how a change in users of ESG data could impact the data reporting, and finally, we're going to talk about how the recent ESG integration plans from the rating agencies will impact ESG investing. We'll be talking with two people who have thought for a long time about ESG data. Christine Pishko is U.S. Signatory Relationship Manager for the UN-supported Principles for Responsible Investments, also known as PRI. Before joining PRI, she was a Managing Director, Lead Client Portfolio Manager for the ESG and Impact Public Equity and Fixed Income Strategies at Nuveen. Tom Koo leads Truvalue Index, where he builds benchmarks for ESG investment strategies using ETFs, mutual funds, and institutional accounts. Before Truvalue, he was an Executive Director, Global Head of ESG Indices at MSCI. Now, I believe it's important to frame any conversation around ESG with some basics. So could each of you outline a couple of things? First, the clients that we are going to talk about today, and say a little bit about each of your firms so we can put your comments in perspective. Christine?
Sure. Thank you very much. So PRI was founded in 2006. We're a global membership organization, and we bring together asset owners, investment managers, and service providers with the goal and the mission of together developing and promoting frameworks for the incorporation of environmental, social, and governance information to investment policies and practices. The end goal of all of this really is to achieve better long-term investment returns and really to support global sustainable markets. The clients that we serve are membership, or as we refer to them, they're our signatories. They commit to 6 principles, and I can briefly describe those as incorporating responsible investment principles into their investment decision-making and policies. They advocate for disclosure on material ESG factors related to investments. They promote these principles in the marketplace. They collaborate with other signatories on best practices. And finally, signatories are obligated to report annually on their responsible investment activities. So as a U.S. relationship manager, my role is actually to support these clients or signatories, as well as manage the process by which new signatories come on board to our organization. In the U.S., most of the largest investment managers are already on board, and asset owners, even though they represent a pretty big proportion of our assets that we represent, they've historically lagged a little bit in numbers relative to investment managers. And one of the things that we've seen more recently that's interesting is we've seen an increased interest from both asset owners and service providers. Some interesting organizations to note is from city and state treasuries to city and state pensions. I would say interest is on the rise from the public sector. Another group of asset owners worth noting, and I think you and I know this from a recent CFA Society event here in New York, is U.S. insurance companies. They've begun to express interest. So we have a number of insurance signatories in Europe, but just this past year, the Reinsurance Group of America became the first U.S.-based insurance firm to sign the principles. So that's really exciting news for us. It's a great attestation to growing recognition of ESG issues, which I think are pretty significant in the insurance sector.
Great. I think we're going to dig into this a little bit, but it's just something that occurred to me now. You mentioned the signatories work with each other and collaborate. Could you give us an example of what that looks like?
Yeah, so collaboration is one of our principles. It's one of the things that we want our signatories to do. It could be groups of investors working together, for example, with issuers in the fixed income market, wanting to establish certain reporting requirements, certain ESG criteria to be incorporated into an issue that they launch into the market. It could be groups of investors working to engage with companies on areas of concern. We actually have at PRI, we have a collaboration platform that does just that, is puts investors together to identify issues and allow them to identify one another in the marketplace to come together and work on something that's specific to their particular portfolios or business practices.
And Tom?
Yes. My name is Tom Koo. I work for Truvalue Labs as the head of indexes, as Rob said. Truvalue Labs is a technology firm that uses natural language processing and machine learning to source ESG signals from unstructured data. So it's very different than the traditional approach to ESG research. What we get is artificial intelligence-driven ESG signals that are available to clients in various formats, whether it's on a platform, a data feed, or in one of the major platforms such as FactSet or Refinitiv. But the fundamental issue is that we are looking for different signals from different sources than the traditional firms are. Truvalue Labs was founded in 2013. It's based in San Francisco and currently employs about 50 people in the U.S. and Europe. My role there is to help clients create indices based on the data that we produce, and we can do that in various ways, including licensing our data to asset managers or index providers who are interested in creating benchmarks. Similarly, we're in the process of creating our own, and in each case, the idea is that the benchmarks would be used to support passive investments, whether they're ETFs, mutual funds, or institutional accounts. We also, of course, use them to create structured products.
I know this is a difficult question, but do you have a typical client?
Well, we have a typical client in that they are either committed themselves on ESG, or they have a client who are committed on ESG. So it's a derived demand, if you will. But we work across the value chain, which is driven by asset owners in the first instance, mediated through investment consultants, and then eventually asset managers. Most of our clients are asset managers, and as I said, some of them are interested in ESG because they have a belief that it will integrating ESG into their investment process will enhance their investment approach. There are also clients whose interest in ESG is driven by the fact that they have a client who's got an ESG mandate. So we work across the value chain. We have clients across the globe. As you might imagine, given the contours of the ESG investment market these days, we have a growing number of clients in Europe, but we're also seeing progress here in the US. One other type of client that's probably less typical in ESG that we have are quants and hedge funds. And that's because we're, in addition to being an ESG data set, an alternative data set. As I mentioned, we're sourcing information that's different than what else is available, and we're sourcing it from different places. And so we've found interest among quants and hedge funds in this kind of information as well.
Okay, so this is one of the issues that has been bouncing around ESG for a while, is the quality of the data. Do either of you have any thoughts on where the quality of the data is now and what you hear from people about what they want?
The data is better than it's ever been, and the complaints are louder than they've ever been.
That's fair.
It's a really remarkable situation. I believe that ESG research has never been more sophisticated. I think the resources that are being brought to the research effort on the part of the different providers are greater than ever before. I think that if you will, the ask on the part of clients is more sophisticated than it's ever been, but there is a general, I would say, dissatisfaction across the market with ESG research. And it stems from a few fundamental things, one of which is the fact that if you're working with company reported data, you're working with data that is unaudited. And there's evidence showing, not surprisingly, that companies underreport bad news and overreport good news. perfectly, I would say, aligned with their incentive in this case. So I think analysis that depends on company reported data has some limitations in that regard. Secondly, I think clients are concerned about the timeliness of the information and how investment relevant it is. You can imagine a situation where a CSR report is issued, say in May of a new fiscal year, using data as of the end of December from the prior fiscal year. And then the typical ESG rating agency, some months later, will rate that industry, and that rating will stand for 12 months. And so you not only have dated information informing the ratings, you have ratings that themselves become stale over time. And as I said, I think are less investment actionable than most investors would prefer. I started in this business longer ago than I care to admit, but let's just say 25 or so years ago. And early on, doing ESG research at Kinder Leidenberg Domini, which became known as KLD, we were in the pre-digital age, working with printed material. There was some stuff in databases, but it was very early stage. The internet was just sort of coming online in the 90s. But the project that the ESG research firms were engaged in was finding any information at all about ESG issues, and it was scarce. So essentially, they were solving a scarcity problem. And if you fast forward into the late 90s, with the internet becoming more prevalent, you've got search engines, you've got a situation where the sort of financials of information gathering and distribution are being fundamentally altered by the internet. And all of a sudden, clients are inundated with information. And they're having a hard time figuring out what it means. And the role of the ESG rating agencies changed from solving a scarcity problem to solving a problem of abundance. And this is the period in the late 90s and the early 2000s when ESG ratings evolved to address that problem. We're now entering into an era where there's a superabundance of data. There was an IBM study published a couple of years ago that said that 90% of the information available in the world was produced within the last 2 years. I mean, information is just exploding out there. And if you think about the nature of ESG issues and what it is that we're trying to analyze, if you're not looking in the vast and growing world of unstructured data, you're fundamentally missing an important part of what's framing the market's perspective on companies from the perspective of a wide range of stakeholders. So I think that we're entering into a period where ESG research is going to transform pretty dramatically through the use of technology, because it's only through the application of machine learning, natural language processing, and other forms of artificial intelligence that you can really find and analyze the volume of information that's out there. We estimate at Truvalue Labs, we sort of did a back of the envelope calculation and said that we analyze in a month what would take a single analyst 6 years to look at. I don't know if I've got those numbers exactly right, but the order of magnitude is right. The point being that technology not only helps us search out signals in this information, it also enables us to capture it on a daily basis and roll it into more timely and current investment signals based on ESG factors. And so one of the things that the Truvalue Labs is able to do is collect the information daily. I mentioned we roll it into a trailing 12-month exponentially weighted score, which is a lot of fancy terminology for the fact that the newest information is weighted most heavily. and the older information sort of times out as it becomes more dated. The point is, you get a very a dynamic signal, which, as compared to the stale signals, which I described earlier, are much more actionable from an investment standpoint. And the other thing that you get is that signals on materiality that you may not expect. SASB has done a very good job, I think, identifying which issues are most material in a given industry. But one of the things that we're able to observe, simply going out to the data sphere, collecting information relative to companies and the different issues, is to find that there are sort of emerging materiality signals at companies that may not be what you would anticipate. And they're simply reflected back to us from the market by looking at all this unstructured data. And so, as I said, I think technology is going to be very critical in a number of different ways for driving the future of ESG research and resolving some of the concerns that the marketplace has about it these days. But by contrast, what we're able to do using technology is get daily signals on these issues and roll those into sort of a longer term view of the trajectory of what's going on at these companies with regard to ESG issues. And at Truvalue Labs, we use the SASB framework, the framework put together by the Sustainable Accounting Standards Board, which is an industry vetted and supported group that has set materiality standards for companies and investors. And that brings me to the sort of the third concern, which is the lack of transparency on the part of the rating companies for the most part, because most of them have differentiated themselves by creating proprietary rating frameworks. And while it's served them well in terms of differentiation, it's confusing to investors. And among other things, we see complaints regularly about the lack of correlation between ratings, which makes it confusing for investors to figure out how to use the ratings and which rating company to choose.
Yeah, why would ratings be comparable? They use different scales for them and everything. So, do you feel like the trends in the rating agencies' assessments are broadening that spread between those? And do you think that there are any particular subsectors that the rating agencies are using for this are bigger? Is it more difficult, or makes the job more difficult on corporates, or more difficult on sovereigns, or other types of ratings?
Generally speaking, I'd say this marketplace has come to fixed income later than equities. It really started as a project within equity investment and the public markets, and over the last 10 years, but particularly in the last 5 years, more and more effort has gone into fixed income. And so that's a relatively newer area, and things like sovereign ratings on ESG issues and sustainability issues are still very much in development. Even within the equity ratings, I think those are evolving quite rapidly. In addition to using company reported data, of course, many of the rating agencies use information that comes from external third parties. And that kind of information will naturally lead to differentiation because they're looking at different sources. They're choosing those sources because they fit the perspective of their framework. And frankly, I'm not one of those people who is greatly concerned about the lack of correlation among ratings. I think it's an issue that will get sorted out by the market. I think it's to be expected in a field that's as nascent as ESG research. And I think that over time, investors will solve this problem on their own. Having said that, one of the ways they're doing that is by sourcing data from a number of different ESG rating agencies and focusing less on the top line rating itself and more on the underlying rating, and using that information to come to their own perspective on these issues. And increasingly, that's the trend in the marketplace. And that's a way in which the asset managers themselves can differentiate on ESG.
Christine, PRI signatories are some of the major consumers of this data.
Absolutely.
Have you heard from them about these types of issues or others?
Well, I think that that's an issue in the marketplace broadly. And I think one of the things you can really make a distinction between, but then you can also look at side by side, are ESG ratings, and then to the extent to which credit ratings agencies are using ESG information. So we've seen both. I know that we're going to talk about credit ratings agencies and the evolution there a little bit later in our conversation. But absolutely, I think that, when you look at how we're thinking about passive investing and how we're thinking about the challenges to constructing indexes and passive investment products broadly, one of the biggest challenges that we see is around the availability and consistency of corporate data, as Tom suggested. It's the consistency of ESG scores. It's managing, then within the context of an index, it's going to be managing portfolio skews, because once you have certain classes of investments and categories of investments that are naturally gravitate and have higher ratings than others, you have to manage those portfolio skews. And then I think one of the things that we haven't talked about quite yet as it relates to this market and the development of this market is costs associated with the incorporation of ESG research, right? So one of the things that's really taken us to the place where we see this tremendous increased interest in passive investing and responsible investing. For passive investing, the big driver of that has been a lot of investors don't think that there is a tremendous opportunity to achieve excess return outside conventional benchmarks that they necessarily want to pay for in every asset class, right? So large swaths of asset classes are being managed in a passive way. That helps save a little bit of money, but once you have to turn around and apply ESG research, particularly if you're using more than one, each of them comes at a cost. I think that's something that is also going to be a challenge to the growth of this particular industry and to investors.
So what do you all think they do in the squeeze if you got the collapse in fees around passive investments and higher expenses in terms of data? What squeezes?
Well, I think the real issue here is that asset managers who are who have a strong conviction around the efficacy of ESG factors see it as a way of improving their investment process. So it's not just a cost; it's additional information that enhances their investment process. And I think that's really critical here, because we're talking about a marketplace that is skewed toward a lot of short-term decision making. And what the focus on sustainability and ESG issues brings is an opportunity to bring a longer term perspective into the investment process and look at risks and opportunities across a broader time horizon than is often done in investment these days. And so I think it's really important not just to see it as a cost, number one. Number two, we are sort of at a sort of very special moment in time, in the sense that there's a lot of momentum behind ESG investing. There's momentum, of course, behind passive investing. And I think there's a third factor that's often overlooked in this context, and that is the rise of factor investing. Which in many ways I think paved the way for a lot of the interest in passive ESG, because whereas 10 or 15 years ago, passive factor investing was not really that big a deal, the market has come to accept it. They get the benefits of the cost efficiency of passive, along with the opportunity to get very pure factor exposure. And it's not a sort of a large leap to see ESG as another investment factor. Now, it's not an investment factor necessarily in the Fama French sense, but in terms of seeking exposure in a transparent way, transparent and cost-efficient way, ESG really fits that model. And so I think the market really is very ripe for ESG in that sense. And at the same time as passive factor investments receive a modest premium over plain vanilla investments, I think ESG justifies that as well. It takes more resources. You're getting something that's distinct and different, and investors who care about it are willing to pay for it.
Right. I mean, I think I absolutely agree with those comments. I think that one of the reasons we're here is that there has been a broader understanding in the marketplace now that ESG evaluation leads to better performance, through its application, through looking at those individual factors. And I think that's what brought a lot of the asset owners to the table, is that they really want to be able to incorporate that into their investment portfolios. I think it's really important to note ESG can be used as a risk mitigation tool, which is something that's going to add value to the portfolio. Or it can be used, to your point about factor investing, it can be used to moderate risk around specific issues. If you look at something like, if you want to take and shore up your portfolio around the risks of a transition to a low carbon economy, particularly if you're a very long-term investor, this is something that's going to become relevant to the entire market, right? It's not just those who are seeking to have a values tilt on their portfolio. It's anyone who wants to have that risk mitigation. So I think that as we move forward and we see some level of convergence of terminology, more consistent data, you brought up the data issue earlier, which still I think is continuing to evolve. I think we're going to see more and more investment in ESG that is passive. And one indication of some of that sort of convergence of terms would be the introduction of the EU taxonomy just in June. And I think that's one indication of progress along those lines.
Yeah, I'm going to upset my friends who are active managers and agree with you, Christine. I actually think that ESG fits very well with passive, because passive investing fundamentally is a long-term buy and hold strategy. It's low turnover. You're invested in the companies, and you have an opportunity for engagement that I think is even greater perhaps than in some actively managed portfolios.
Well, so I guess this leads to a logical progression, as PRI has seen a change in signatories, and we have certainly seen a change in our events here in the composition of the audiences at our AOS events on ESG, as well as in our sustainable group. What do you all think will happen as the stakeholders change? How will that change the indices, and how will it change the way they're used?
Well, I can absolutely speak to, I talked a little bit earlier about how a lot of investment managers have come on board early in the process. So, the asset owners in numbers, though, again, assets represented are strong, in numbers are still building. If you use the growth of our signatory base as a proxy for interest, 10 years ago, our signatory base was less than 300 organizations, and around the globe now, we're 2,500 investors. That's 86 trillion, right, in assets under management. So I think that that's something that is certainly notable. But more interesting than that, in the U.S., it's building, and it's one of the fastest growing areas. A lot of people think that Europe is leading the way. I just mentioned the EU taxonomy. That's something very much out there and is in progress. But in the U.S., over 475 signatories now is where we stand. It's the fastest growing part of our market, over 20% growth in our signatory base alone in 2018. So I think that's where you're going to continue to see growth. If you look to the U.S., I think that these asset owners are going to be doing a lot to drive change, to drive investment managers to meet their needs. I think that in a lot of ways, they are relying upon investment managers to let them know what's possible in the market, what they have access to, the data they have access to, how they can report on it. But it's going to come from the asset owners who are making those demands and asking for these types of information to be delivered to them.
We're talking a lot about asset owners. I think it's important to note the extent to which ESG, in some sense, has filtered down from the institutional marketplace into wealth management, and that's really important. Many new investment strategies get tested and vetted in the institutional marketplace, and then they become available to a broader range of investors, and that's happening with ESG. I noticed recently, and this is data from Morningstar, that the flows into U.S. ESG funds in the first 2 quarters of 2019 were close to $9 trillion. Which exceeds the 5+ trillion in all of 2018. So first 2 quarters almost doubled last year's flows. And I think we've really turned a corner. And it's been a combination of different things, one of which, as I said, is the sort of the downstreaming, if you will, of ESG into wealth management, but also over the last several years, the ecosystem of ESG funds has really evolved very dramatically, and there are more and more choices available to investors in more asset classes, and both retail and wealth clients are beginning to understand that there really are good options for them to invest. Now, one of the challenges here, of course, is that many of these funds are different, and what one fund won't hold may be found in another fund. And I know critics of ESG investing look at this and go, well, how do you know it when you see it? And the answer is, it's just like any other kind of investment. Investors need to be smart and careful about what they invest in. Look under the hood, read the, I dare say this, read the prospectus to understand what the investment philosophy of the fund is in order to figure out whether or not it's appropriate for you or not. But the point is that it's working. More and more funds have come to market. Flows are starting to pick up. Financial advisors are more and more comfortable advising their clients on sustainable investment. And it's turned from a sort of chicken and egg standoff into something of a virtuous circle.
Right. Well, I think a lot of that stems from we've lost the performance concerns. There are so many more options available. You can build a complete portfolio with credible solutions, with strong performance and track records. So I'm really excited to see those flows as well.
Yeah, I talked to 2 different family office executives in the last couple of months who viewed the disparity in the types of funds out there as a way they could actually add value because of the due diligence requirements and because there aren't a lot of other FAs out there in the world who already have these nailed down. So I thought that was interesting to your point, Tom. Some people are looking at that as a way to differentiate either or increase their asset allocation diversification benefits or actually increase their returns. So one of the things that we touched on earlier that I am keenly interested in, particularly because I used to work at one, is the impact that the rating agencies will have on the process going forward within ESG data as well as ESG investments. So the Moody's, if I remember correctly, was early to the game. S&P came on after that, and then Fitch came on a little while later. They are transparent-ish and can be a little bit challenging to understand in terms of the ratings, particularly in some of the subsectors. So what do you say? What do you hear?
So actually, that's really interesting. So now we're talking about credit rating agencies ratings as opposed to what we've been doing The majority of this conversation has been around ESG rating agencies. And that's something we're focused on at PRI. In 2016, we had a work stream. It's still ongoing, led by Carmen Enzo, who's the head of our fixed income group. She launched a project with the objective of trying to understand how ESG factors may impact credit risk. So it's the likelihood, obviously, that a bond issuer or bond issue defaults. So this very specific project. And it's a huge proportion of assets that our signatories hold, fixed income. But as I think, Tom, you mentioned it before, it's not an area that has been longstanding in the world of ESG data, right? So this is still something that's probably grown up, I would say, around the last 7 years. It's been getting a lot more focus. One of the things that we really thought was important about this particular work stream was to engage the major rating agencies because they're a key stakeholder in this market. And understanding that consideration, there's a way that you can take and you can transfer that information of ESG incorporation towards specific issuers. It's very elaborate now with corporates, for example, and you can apply it. But consideration for ESG factors, even in the credit market, is going to go beyond the evaluation of an issuer to include either an evaluation at the issue or at the portfolio level, because you have different layers of visibility. There are time issues with fixed income securities, so how that time consideration can have an impact on credit worthiness. For example, if you have ESG factors taken into consideration, you can have a 2-year credit of an issuer that may be attractive, for example, but not the 10-year one, because looking further out, you see concerns around the ESG evaluation, or conversely, you can see that credit quality of a company can be strong. It's got a solid balance sheet, but you look at the ESG quality score and not so much. So it's not very black and white in fixed income. It's a little bit more nuanced. And for that reason, we developed this project. We created a statement, actually, that our signatories can still sign. And it's about promoting transparency and how the rating agencies are incorporating ESG criteria into their ratings. Right now, we have 153 institutional investors that are involved. That's 30 trillion in assets, and 19 credit rating agencies, including the 3 largest ones, are involved in this initiative. So it's pretty exciting.
I think the initiative is great. It's I'd say they're late to the market, late to the game, and slow to change, if I may offer that perspective.
We're working on it.
Understood. I think it's really important, obviously. The steps they've taken thus far have been kind of baby steps in terms of sort of bringing ESG kind of up to and kind of next to what they're doing, but it's not fundamentally integrated yet into what they're doing. And I this will evolve over time, but it really has been it's been slow to happen. My guess is it'll be slow to change. There are signs now because the 3 major credit rating agencies are competing on ESG. I think that's going to sort of hothouse the process a little bit, which is probably a good development. And of course, given how critical fixed income is to the sort of broader investment world, this is certainly a good development. There is research, academic research, coming out of major universities and business schools. I'm thinking particularly of some recent research by Witold Hennis of Wharton, who's done some work on the relationship between credit risk and the scores that a firm like Truvalue Labs provides. showing that the lower the score, the higher the credit risk. And increasingly, I think we're going to see the kind of both academic and practitioner research that really supports the efficacy of taking into account environmental, social, and governance factors when thinking about credit risk. There's also work done by Barclays on this issue, which essentially shows the same thing. So we're moving along in fixed income. It's not where we'd want it to be ideally.
Yeah, well, so that's a large part of how this project came to be at PRI. So we've run investor surveys to understand how much they know. This started back in 2016. This statement is still available to sign. So we welcome your signature, Tom. We have actually run 20 different collaborative workshops globally on these topics. We have published 3 substantial reports on identifying how factors are already incorporated into it, identifying the disconnects between what they are and are not doing, along with a series of recommendations for investors and credit rating agencies. So all of that information is actually available on our website, as well as the statement, which I can say is still available to sign.
Well, thank you all. I think we should leave it there. Perhaps come back in 6 months and see how the assets have grown, how the asset owners have grown, and mark the other portions of those things. But thank you to both of you for your time.
Thank you.
Thank you, Rob.
Thanks for listening in to Compound Insights. If you haven't already, please subscribe on Google Play, iTunes, or wherever you get your podcasts. You can also find out more at cfany.org, including links to some of the articles mentioned on this podcast and the agenda for our ESG Summit set for September 23 and 24. Our next podcast will be out in 2 weeks and will be on the intricacies of wealthy family meetings and long-term wealth management.